my best performing and oddly enough, the lowest risk, more stable asset class is our medical real estate portfolio. The business plan behind that is buy a bunch of medical offices like dentist offices. Dentists are 80% of the portfolio, and a lot of them are just single buildings. So they're not large. This isn't like 50,000 square foot medical office building, but they don't go anywhere. Dentists are in there. They spend so much money building out that unit, and they sign 10, 15-year leases, triple net leases. They pay for their own maintenance. It's like, from an asset management standpoint, it's mostly easy.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Flint Jamison, aerospace engineer turned fund manager. Dude, I'm stoked to have you here because I was listening to other podcasts you have. I've seen you on LinkedIn. I've seen some of the posts you had, and also the way you talk about the transferable skills from being an engineer over to your Vestus Capital today is really cool. And by the way, not everyone gets to start off their story of how they got into real estate because of walking their dog. And look at where you are today. So
that's funny. You pulled that. Yeah, I guess I don't talk about that much, but that's true. I got into digesting podcasts while walking my dog. Oftentimes after putting the kids to sleep in the dark. It was awesome because it was just me and the dog out there, even in the dark, just on a trail, and me and the dog and the coyotes, to be honest. And I got into my first duplex. I did the BRRRR thing. It's a wild story of its own. And then after that, I was like, there's probably a better way. And then I jumped into, somehow through another podcast, I found commercial real estate syndications and jumped in with both feet on that. And so I went from literally a duplex to my first deal was a 104 unit complex with partners.
Yeah, that's super cool. So, I mean, you've had this background from aerospace engineering, including working on the Boeing 787, which is really cool. My dad works for Boeing today, and you were up there in Everett Field, Washington, all the way up north from Seattle for whoever's listening, especially those tech professionals in Seattle. We've got a not quite sort of local boy here for the Seattle area.
Nice. Yeah.
But return to the fund management side, and this wasn't something that happened overnight, right? You were talking about.
Oddly enough, it's crazy how quickly the transition happened for me. And I would say everything through my transition, all of it is serendipitous. None of it was planned, like from the duplex to the commercial real estate syndication. But it was like 3 months after we closed on that first 104 unit property, I got invited to open a fund and be a fund manager on a 3 property portfolio. So I was like, in my mind, had you asked me 3 months earlier, you're going to be a fund manager soon? I'd be like, no, I got to get 5 years in before I do that. No, and then they're like, no, you don't have to, Flynn. You can just do it.
That's cool. What a way to break beliefs, right? As well.
Yeah.
What was that first impression of after investment? Like, you could do this. What were you thinking?
I guess I had the right people that were mentoring me, and they're just like, it's just like doing another single property asset, but this time you create an SPV as a fund to fund and you write a big check. And so what I did with that, and the reason why it was much easier and palatable, is I brought in other capital raisers like myself. There was 6 of us, and we all partnered as essentially co-GPs as fund managers.
Cool.
And then we wrote a big $1.25 million check that went into the primary fund, which was $30 million, I believe.
Awesome.
And that $30 million went into buying 3 different properties in 2 states and 3 different cities. So it's a diversified portfolio. And I'm still a huge advocate of doing portfolio, like multiple properties, because single deals, I mean, if that one deal doesn't perform well, it's all on its own.
Yeah. That's how should I say, almost the thing where we all kind of start from a single, you might buy one property, probably similar to the BRRRR thing that you had, which I think you said was a duplex, but really thinking about, again, from an engineering background as well, if I have 1 or 2 doors and one door goes away, I have 50% gone, right? You're tapped out on your own cash as well. So You have some really cool insights about this that I want to unpack, because from those that are listening and hearing about commercial real estate or just starting to get into it for the first time, but also just kind of walking this journey to where you are right now, it's important for you to share what you've learned to break their beliefs as well. Right. And so talk about this. What was that like? I'm going to go into that duplex. We won't have to spend a ton of time here, but just kind of what was this scenario and what are the things that you learned about? Yeah, I'm not doing that again.
What I'm not doing again with the BRRRR?
Yeah. You only did one of them, right?
Yeah.
And you decided to do something else.
The BRRRR ended up being super painful. And ultimately, I ended up losing money as I calculated after the fact.
Mm-hmm.
Not only was it super painful to hit an extra 3 months of delay just doing the rehab, various things were showing up. I guess one of the examples, just to give you guys an example, it was supposed to be 3 months to renovate the property. And one thing that came up is when we walk the property, you go into the garage, it's a separate garage, and there's a light switch and there's a light. We're like, oh, well, we'll just add a garage door opener too. That's easy.
Sure.
And then we just need to replace the bulb. Well, it turns out that there wasn't any power to the garage, period. They had somehow wired, for some reason, they wired in a light switch and put actually a light bulb in, but they didn't do any, like, no power from the house to the.
All for show, huh?
All for show.
Wow.
And so it's just, that's where costs just skyrocketed, because that was like another $1,500 to $2,000 to trench a line and have an electrician get in there. So it's things like that. It was a bit of a kick in the pants. And then at the end, I was profiting like $300 per door, which was at the time BiggerPockets. This was in 2018. BiggerPockets said on average, people are profiting $200 per door.
Mm-hmm.
And I was doing 300 per door, and I had two of them. And I was like, oh, this is fun.
Yeah.
But you extrapolate this out, go back to the $200 per door. And I'm like, if I want to do $100,000 in my pocket,
right,
I'm going to have to do 50 units. And those 2 units was a kick in the pants and a lot of money that I didn't get back per the BRRRR strategy. So I was like, this is going to take forever and a ton of effort. It's just not easily scalable. And that's kind of where, once you get another podcast, hey, you can do syndications and partner with experienced people and do big blah, blah, blah. So that's, at that point, I'm like, oh, okay, well, I'll just do that instead. Yeah. And then I went into the education on that, and that took a while.
Yeah. I mean, it just simply isn't return on the return of energy, return of effort.
Yes.
Right.
Absolutely.
A different kind of ROE, not return on equity here, but
it's you're taking on another job. And I'm like, I don't necessarily want my job to be a landlord.
Mm-hmm. Were you still at your W-2 at this point?
Oh, yeah. I was at my W-2. So that was in 2018 that I first bought that. I didn't leave my W-2 until 2023.
Nice. Awesome. Yeah. So trying to manage something like that on the side while working, definitely a lot more effort. And I mean, you've done the engineering stuff, but also as a program lead as well. I know you picked up a ton of skills there. It's probably useful, but also doing the math of what you're talking about, return on effort, just didn't work out, right?
Yeah. And 2 kids. And I was burning the midnight fuel a lot, just trying to build the business. But when you can see that there's something advantageous, there's light at the end of the tunnel, like when I jumped over the syndications, that's when the motivation hit. Because with the duplex, if I was going to still burn the midnight oil to buy another duplex, and it's just been taking forever.
Yeah, wouldn't be worth it. So what did you end up doing to educate yourself? Because there's a lot of information out there, right? What did you end up going through?
Yeah, I found a mentor. There's a lot of gurus out there, and I went and did the guru thing. I think I spent like $5,000 just for the recorded video courses. Mm-hmm. And in hindsight, I'm really glad I did that, because a lot of people would spend the $30,000 mentorship, and that's like all these guarantees of you do this and we'll get you your first apartment in 12 months. Mm-hmm. I think there was only a 10% success rate out of the people spending $30,000, and I only spent $5,000, and they got the same recorded videos. That they just had a mentor on the back end that would help them acquire property. So I got all of the education. And then here's the key thing. It's something I had to learn myself is you're supposed to go into these partnerships with complementary skills in people. And you go and you're supposed to choose, oh, I'm really good at asset management or underwriting, whatever it's going to be.
Right.
But in my mind, maybe it's the engineer in me or the program manager in me that I was like, I really need to intimately understand everything. And there's a certain point that you should understand the whole picture, but you don't have to be a mile wide and a mile deep. Otherwise, you're never going to get anything done. I got stuck in that rabbit hole of trying to be a mile wide and a mile deep when I really should have dialed that back a bit and chosen my alley.
How long were you there for?
Well, I mean, I started educating in 2019. I didn't jump into my first deal until it was really late 2021. We closed in January 2022. So it was a while. The other thing that I recommend when getting educated is, yes, take the cheap recorded video, whatever it is, syndications, get your mile wide knowledge. And then find a very specific coach or mentor that'll teach you how to be a mile deep in that one thing. That way you're really being focused. I serendipitously did that after I did the $5,000 course, and then I jumped in with some mentors on how to do capital raising, and then I jumped in with a sales coach on how to do sales because I'm an engineer and I have no idea how to do sales. Yeah. I'd still say I suck at doing sales, but it's working out really well for me because I think people see that I'm not a salesman.
Right.
So it works.
Yeah, I think so I just want to emphasize that because I think I asked that question of how long were you in that phase for? And just to go back to be explicit, it's like that learning phase and almost that, I don't want to call it analysis paralysis looking backwards. Maybe feel free to push back on me there, right?
No, it is.
But okay, hindsight 2020 kind of thing. Maybe if we had a better coach at the time, they would have said jumped in faster. But the idea of taking that time to go to learn, at least kind of survey what all the different asset classes are, how they work, what their return profiles are, an idea of where should I start to build an asset allocation and things like that. Yeah. And then go deeper. So you would say it is analysis paralysis. And how would you do it differently?
I was running solo for a long time. In my head, I was going to be with a group of people that are going to be the experts in the Denver, Colorado area, do Class B value adds. The cookie cutter business plan.
Yep.
But I hadn't found the partners yet. So I think that was part of the crux is I was still trying to learn be mile wide, mile deep because I didn't have partners and didn't know how we were going to parse out. But I did start doing, they say underwrite 100 deals just to get really good at it and understand the numbers. And I'm like, okay. So I started doing it, but none of the deals would pencil. And when you're running solo, you tend to get these blinders on and you don't get challenged on certain things. Some of those could have probably worked out, but I didn't have someone challenging me on my assumptions. And then where I finally broke through was I had been following some other syndicators that were doing pretty well. And I ran into them at the conference and they said that they're bringing in some co-GPs to raise capital. And I'm like, oh, perfect.
Yeah,
I'll do that. Just get my foot in the door. And it's way easier to sell and bring investors when there's experience behind the team versus me being a newbie team with some other people and hoping that people will give us money.
Completely.
That's really what kicked it off.
So I think part of the takeaway there, then what I'm hearing is as you're just starting out, make sure you're joining other people who have that experience as well, even if it's your first investment or you're looking to start going more active than passive as well. Did you find more of your value as well, like more what you can, like you're talking about complementary skills? Did you find more almost like a mirror to yourself by working with other people of, oh, these are the things I actually am good at. So let me find, this is a place where I can contribute. Oh, you don't know that stuff? I got this.
Yeah, there's a bit of that. Yeah. Also, I think it comes down to what you're willing or wanting to do. Because like acquisitions is all about building relationships with brokers around the country. And sometimes you got to fly and visit these brokers, meet with them for coffee just to get that relationship. So they will send you some good deals.
Right.
And some of that's a grind. I don't want to do that. I want to be at home because I have kids kind of did the jump in capital raise for someone. And that's kind of what set me free, because I could do that from my house. I don't have to travel anywhere to raise capital. If you're an asset manager, you should be on site once a month or something, right? Or multiple times a week. If
I was going to say,
you just get it. It all depends on how good your property manager is, and it depends. But yeah, asset managers have more responsibility to be on site. And my position, I don't.
Yeah. Well, today you have a portfolio of 1,500 plus units, right? And not only that, but you're investing in medical office buildings. I think you were talking about like a tech startup that you were doing. But multiple asset classes, multiple locations at what you're talking about.
Yeah.
And this had really kind of set you free. I do want to talk about that, but I also just remembered what you talked about here too, which was that about transferable skills, and also maybe some things that will keep people constrained, right? Was it the engineer brain that wanted to keep on learning to be really good? And was that end up being the double-edged sword?
Well, I think there's a lot of things at play. There's the engineer analysis paralysis. There's imposter syndrome that doesn't let you move forward. I think I saw a stat that 75% of people have imposter syndrome. So welcome to the world.
I know, right?
And it's just battling those. And yeah, being an engineer with analysis paralysis. The other thing is designing aircraft is such a team effort, to where if I'm doing a design as a newbie engineer on a wing structures parts, I have a design lead, I have stress people, there's materials people, there's 7 people that have to sign off on a drawing. And before you even get to the drawing, you're just doing reviews constantly. So there's always that backstop of people are there to check your work.
You have a team.
Getting into this, I was kind of, like I said, I was running solo. There's no one checking my work. And then, eventually when you get the partners, that's when you get more of that team feel and things can actually start moving forward.
Yeah, makes you feel like you've got moving forward and traction.
Yeah.
Interestingly, you're talking about marketing and sales. This is something that you weren't as good at. It wasn't part of the skill set as the engineer, but it was the things that you quote unquote weren't good at, which is what you learned to do more of. And ironically, you're much better at them today.
Yeah. I shouldn't be a marketer or sales. I still don't think I'm good at it, but it's working for the time being.
In what ways are you, like, break down? I mean, just describe what some of those activities are when you say marketing sales. What does that mean? Because you're talking to engineers right now too, right? That are listening on this podcast.
Yeah, I think the easiest part is when I end up on the phone with someone. It's the getting someone on the phone. That is by far the hardest. It's getting someone in your funnel, writing the right emails, the right drip campaign, the right LinkedIn post that attracts people. It's a grind. It is a serious grind. It used to be much easier back in the day, but LinkedIn has been my main jam. And back then things were doing great, but nowadays things are much different. Multifamily has gone through a slump. There's been a lot of defaults. The economy right now is in a really weird funk. So investors aren't looking as much. So it's much harder to pull. And on top of that, the LinkedIn algorithm isn't spreading my information the way it used to. So it's playing this game of, you're like selling your soul to some stupid algorithm of social media just to try to get your information out there to hopefully find the person that's like-minded.
But we have to keep trying different things, and you're a big advocate of taking action, right?
You always got to try the next thing, test the new thing. I'm trying to start with YouTube, but the amount of effort to literally sit down with a script and try to give valuable information and then create a video that'll keep people watching, turns out that's hard.
It's a different skill all on its own, for sure.
Yeah.
So when you're thinking about, now you're raising for multiple different deals, right? Well, so you have different opportunities here, and you have looked at that mile wide as well of these different asset classes, and have learned a lot about each of these different asset classes too. When you have new investors on the call, right? People come and say, hey, Flint, I saw that post, or I saw what you were talking about. I really love your education. I'm not sure where to start. What are some things that you start that conversation with so people can hear this conversation, be like, oh, this is how this would start to go. Of course, tailored to everyone specifically, but
yeah, it's almost like a fun maze you got to play with every single person you get on the phone, because it's always starts out, give me your background of investing, and you'll get, the run of the mill. I've only done index funds and on my 401k. Okay, well, I wrote a book.
Yeah, congrats.
So the Engineer's Guide to Real Estate Wealth, I should have it hanging from my ceiling so I could just pull a string and put it on video, but it's back there.
Love it.
It really comes down to education for folks like that. Every once in a while you get someone that's, oh yeah, I've owned 2 single family rentals and I got an Airbnb, and it's okay. So, all right, that's another step forward. You understand what depreciation is. So really it's the conversation is totally tailored. And a lot of my job is more education and guiding someone to, based on your knowledge, here's the best way to get a quick hit on education so you can get there easier. And do you read books or do you want to listen to podcasts? Because I can send you in both directions.
Totally. Yeah. And right. I think the emphasis there is that you do have to jump on a call. You do have to have some of this information or these interactions, these meetings with folks like yourself to go and kind of do that human check, because AI has entered the chat, right? And so a lot of information out there. But as we know, you might do some math on, for your plane, et cetera. But sometimes you have to check your math, right? You have to go like, how does it actually work in the world? What are people doing?
Yeah. I think really nowadays, one thing I tell people is the education doesn't have to be overwhelming. You just have to understand the business model, because the business model in its basic form is easy. Where it gets more challenging is really doing the due diligence on the operator. Because I think for any given investor to truly learn underwriting and pull up their own massive spreadsheet and put in, you're not going to call the insurance companies and get 3 quotes to just validate that the insurance quotes that they have is, there's just a certain point you can't go that far. So it really comes down to trying to vet the operator. And that's kind of where, I guess, here's my pitch to people is, that has become my job as in my real estate / just investing firm at this point, given the number of asset classes. I now no longer am I chasing to be the expert in the Class B value adds in Denver. Serendipitously, I keep using that term. If I was that, all my investors would only be investing in Class B value add assets in Denver, which is totally not diversified, because the Denver market can do its thing and all of your investments go the same way. So I am asset agnostic, I am location agnostic, and I am operator agnostic, but I now try to find a diversified asset classes and locations. And my job is to vet, is to do all of the hard work. And now I have fund manager peers I work with. There's 6 to 8 of us that will find an opportunity. And it's, once again, it's that brain meld team effort where we will all do the due diligence together. And we all come from different backgrounds. We all think differently. So we get a really powerful due diligence effort on an operator before we choose to bring our investors into it.
Yeah. Yeah. There's multiple stages of what you were talking about, right? The opportunity to diversify, but also on due diligence as well. And someone just kind of coming in, I would be like, whoa, you talking about location, asset class, and I got to know how to talk to vet these people. There's a lot of work that goes into that. And I think
so much work. Yeah.
Yeah. To your point, I was like, okay, what value does someone like yourself as a fund manager bring in? That is that experience, right? Having that been in real estate for a while, like this is what good looks like. These are all things that can go wrong. And if you don't have
this is what I don't believe.
Exactly. So just kind of emphasizing on what the value that someone can help you to look at what is right for them when they come on to, and the right education to point to provide those, I don't want to say shortcuts, but I want to say collapse time frame, right? Shortcuts doesn't sound about right. We want collapse time frames. What are some of the other, is there anything that you want to add to that? These are the things as a fund manager that I really do for you for investors?
I mean, I think the majority of it is that upfront due diligence and finding unique asset classes that people aren't going to find on their own. I guess just recently, this is the most recent story where we, as the fund manager group, dove in and did due diligence on a fund opportunity for 4 months. And we nearly pulled the trigger.
Wow.
And then some certain red flags started popping up. And this was a totally different asset class. This was a crypto hedge fund. We're looking for wildly different return profiles, I guess is the best way to say it, and different asset classes uncorrelated to the stock market, uncorrelated to real estate. Yes, there's a way different risk level, but all investors have different risk levels. This one, the returns were astronomical. And at first I was like, no, that's not real.
Right.
We dug in and it was legit. Things were going really well. And then they kind of went silent for a couple months. We're trying to do due diligence. We're asking them a lot of questions. We're starting to push back. They're like, this is too much. Not even the family offices or institutional investors ask us this many questions. And we're like, sorry.
I know, right?
They got like $100 million. If they put in $1 million, it's not a big deal. But their returns in February and March were way negative. They took all of the 2025 gains, like 72% gains and virtually lost half of it.
Damn.
And it's going to take them another 6 months to recover. And I'm like, first off, they kind of went radio silent. And second, their thing broke. And so I'm like, all right, I'm out. That was 4 months of due diligence. We nearly launched it and that happened. So it happened at the right time and we pulled the plug. So that kind of gives you the idea of the amount of effort we put into it before we expose our own investors' money.
Yeah, that's so important. And like you're talking about, you have a group of other fund managers too who also have all of their different expertise. I'm sure not only from aerospace, but from wherever their background is as well, right? Tech or finance, et cetera, who look at things differently. Other real estate people who went in the fund manager more traditional route to getting there.
And the other thing on those is new asset classes, a new education level. We had to get into it. When I got in, I was like, I don't know how to do due diligence on a hedge fund. So we had to educate ourselves even to get to that point. We're creating wild spreadsheets with sharp ratios and it was a new jam, but that's the value I bring because now I can at least educate the investors on the new asset class.
I think that idea of, we say fund manager, also capital allocator, right? Really just having that investor mindset is so accurate. And I think sometimes the words get thrown around without the weight of what they carry. And one of those things is capital allocator. It's like, no, all the things that you just described are what goes into looking at deals, getting deal flow that you would want to underwrite, do risk profiles, do the due diligence at the location, the asset class, the operators, et cetera. That is part of the massive value add, which brings so much certainty to, hey, I think this might work for you based on what you want to do. It kind of gets funneled right there, simplified. What are some of the that's a cool one, the crypto hedge fund. I wouldn't know how to underwrite that. I wouldn't even bring that. But what are some of these other ones that you've seen that I'm just kind of curious to see what you've seen?
I would say my best performing and oddly enough, the lowest risk, most stable asset class is our medical real estate portfolio. The business plan behind that is buy a bunch of medical offices, like dentist offices. Dentists are 80% of the portfolio, and a lot of them are single buildings. So they're not large. This isn't a 50,000 square foot medical office building.
Right.
But they don't go anywhere. Dentists are in there. They spend so much money building out that unit. And they sign 10, 15-year leases, triple net leases.
Right?
They pay for their own maintenance. It's like, from an asset management standpoint, it's mostly easy because you don't, as long as you buy right and they're there for 10, 15 years, you don't want to hear from them.
Right.
They can unclog their own toilets.
Right.
And interestingly, in the medical space, oftentimes because they have unique air control requirements, the HVAC systems on them too. And I've been told in retail world and stuff where the HVAC falls on the landlord and then the roof and exterior. But in these situations, they take on some of those bigger expenses like the HVAC as well.
That's interesting.
Yeah, I mean, the business model, we're up to 75 properties in total. We've got
medical office buildings.
Yeah.
Damn.
So the main operator, once again, I partner with these experts. He had 15 buildings that were friends and family. And then he opened up his health wealth fund. And we did 1 and 2 last year. We overraised on both of those. It was, I think, in total 35 million in equity raised. And this year we opened up fund 3, targeting another 30 million. And we should buy another roughly 50 properties with that 30 million in equity. And the goal is we're going to do 5 funds. I don't know, we're going to end up with 150, 200 properties, and then sell it all to private equity or a healthcare REIT.
Right. I was going to say, that was my next question. What's the exit strategy and all that? That's really cool. I had invested in a medical office building. It was 2020 through 2020, just full cycle last year. And when exactly the multifamily ones I'd invested in was like 5% net, 3%. I'm like, dude.
Or 0.
Yeah. But I was getting just a straight 10 and then a 2x multiple. And so
good.
Like, great.
Yeah.
But that's impressive on scale. That's cool, dude. So the natural question is, Flint, amazing career to investing in this 104 unit property, I think it was, to start with. And then 3 months later, hey, do you want to come raise capital for us, to now doing this and being on this other side of this bridge through the forest on the other side of this land where you flew your plane from. It's okay, but how can I invest too? So I don't know that these nuts and bolts sometimes get talked about. And you were talking about doing this from an SPV, a special purpose vehicle, and a kind of fund to fund model. But talk a little about that, what that structure is, so people can hear about how does this work.
Yeah, it works in various ways. There's many ways to skin that cat, and we pay exorbitant amount of money to SEC attorneys to establish the right documentation and structure. But I guess from an investor perspective, you can know the high level, but it doesn't really matter. I think from an investor, you learn about the deal. If you like the deal and it fits your goals, you get in the portal and review the docs and sign and wire money, and it's relatively easy. But from more of the operator perspective, to your question, a fund to fund or a feeder fund, I guess there's several ways to call it. It's like a special purpose vehicle. It's a Reg D 506C or 506B filing. And there's an LLC that is that fund. And then we create another LLC that's the manager LLC to manage that fund. And then above that is Vestas Capital. So there's this tree structure that gets kind of confusing. But it works the same. If an apartment operator, they create Main Street Apartments LLC. Then they have the management for Main Street Apartments LLC. And then they typically, all of the partners have their own personal LLC above that. So in general, with the fund to fund, it's the same flavor of structure. But with the fund to fund, we raise the big check and then we write a check as an investor, LPs, into that other fund.
Yeah. And I wish we had a picture for this. We could just flash on screen or say, go here to look at that. I'm sure you can find it on
a diagram.
Yeah. But effectively, right, to your point, for the investor, his listing is like, all right, that's a lot of boxes that you just had me imagine. But really, feeder fund is probably one of the easiest to imagine here, which is there's the deal and the investor, functionally how it works, investor, well, just here's the account numbers, et cetera, that you would plug in to go to an investor portal, which is, if you're in software or anything else, it is more easy than anything you've ever built, we promise. Go in there, plug in this stuff, do your due diligence, send the stuff, and the money finds its way to actually go into the asset, where the capital needs to start working as it does, like you would buy any property, and then you get tenants in and you do whatever the business model is, and you get your returns, and that's how investors get paid, right? Yep. I'm sure you've got resources on your site for this too, so you don't have to visualize it all in your head. Like, what does it mean, fund to fund?
I think another valuable point to add here is, what's the value of a feeder fund rather than just investing directly into the primary fund?
Exactly.
There's a couple of things to that. One, I have a relationship with all my investors and they trust that I'm doing the due diligence. So they invest with me. But my goal isn't to have them invest. I skim something off the top and they get lesser returns than the primary fund would. The goal is that I raise enough money that I write the really big check to get preferential returns from the parent fund. Ideally, I can give you the same exact return profile, or if not slightly better.
Or better,
Now,
right?
or better sometimes. It all depends on how much headroom there is on the deal. And then another aspect of this, let's talk about that crypto hedge fund. Their minimum is 400K.
Yeah.
And so I don't know anyone that wants to put 400K into something like that unless they're like have $50 million. People are more willing to take that risk level at a smaller check size. So that's where the benefit comes in. I can take in a bunch of 25, 50K checks and write a 500K, 750K check to the primary fund. Similarly, there was a debt fund that we almost got into. They started out with their minimum being 250K. Then they raised it to 500K like 3 months later. And then another 3 months later, it was $1 million minimum. So yeah, it's just what we do allows you access to things that most people don't have access to.
Dude, that's such a good point, right? That's such a good point because I know that there are a couple, we see them all the time, right? Looking at deals of funds that are like, yes, you could go in, an investor could go in with 100K or 250K into something and get like a 70-30 split. Could get certain types of returns, or you can go in and write that $1 million check, a bigger number check that is just inaccessible to a lot of people. So that part that you're talking about is you bring deal accessibility to people who could get in on it if they wanted to write 25K or 50K checks, which is more accessible, more at the level they feel comfortable to invest in, and where it wouldn't be accessible to them otherwise. And that itself is a value add, relationship value right there too, right?
Yeah.
Yeah. One more point in there is that it's that trust factor, because of all the things you talked about of doing the due diligence, et cetera. But I want to address something that was, I had went through a lot. I'm sure you had went through it. We're trying to collapse timeframes and pass on knowledge here, the entire purpose of serving the listeners. And that is okay, you told me I don't need to know everything about the deal. Flint's doing the underwriting, he's doing due diligence, cool, but I still think I need to know more. I don't know enough. And so what did you exactly? And I'm just like, I think this is it. I've got the checkbox. I need to know this and this. All right, just go. I got to pay to play, right? So talk to me about that kind of turmoil and how you went through it, how you think about it now. If someone still thinks, I like the deal, Flint, you seem like a good dude, but I just got to know more.
So when getting into these, I don't keep it a black box. I provide a deal room, like a Google Drive, that has not only all my analysis, executive summaries and stuff, but all of the information that we received from that operator is all there. So they can technically walk the same road that I walked if they so choose. But really, when people start hemming and hawing, I think it comes down to they're still on that educational path in their own head. They haven't gotten used to it yet. Literally the other day, they were really interested in that health wealth. But then they started randomly talking to their random buddies who only invest in index funds and asking for their opinion. And all they could come back with is, oh, this is a new thing I've never heard of. This is probably a scam. So you get in this world where people have never been exposed to it. And it's going to take, like in marketing, there's 18 touch points before someone will actually call you.
Right.
That's why ads after ads in multiple places. And so I think the similar thing happens psychologically is the first time someone hears about syndicating or getting into a fund and investing in something that they never thought that they could, that, what is it, gator brain or something, that the lizard brain comes in and so sometimes that's fine. If you're going to hem and haw, I'm not here to try to sell you a used car and what's going to take you to get you to drive away today. If it's not for you right now, I would hate to push someone into a deal. I never do. Here's the opportunity. Here's all the effort I put into giving you the information. If you're not comfortable, I don't need your money.
Yeah. Dude, it's really, I love what you said there about, of course, it makes sense to provide the Google Drive, whatever, the repo of the docs. But what you said specifically was, here's all the information, and they could walk the same path as you. And I think the key point that I was hearing on that is, if you give someone the information and you walk them through it, they can come to the same conclusion that you came to. And that's kind of the idea. And I think that speaks so well to the engineer brain, to people brain in general. Just, oh, it's okay. This is the problem. There's tenants missing. We need to add value here. It's like, this is the business plan. So you fix it up. So people want to be there. Great.
Yeah.
Here are the numbers. What are your assumptions? Plug in the variables. At the end of the day, I always think it's funny because I talk to people about syndications or funds or this kind of stuff. And I'm like, dude, the math that you do and the things you do in tech or aerospace, whatever, are going to be significantly more complicated than algebra 2. I promise. As an example.
Yeah.
So just walking them through the data so that you can come to the same conclusion to get that level of certainty, like, okay, this makes sense.
Yeah. There's a great book called Psychology of Money. I mean, he really talks about just the index funds, but beyond that, just the psychology of money. I found it hugely valuable. And a couple of the comments he made is, one, risk is basically it's in the eye of the beholder because everyone has different risk levels. There's no way you can objectively say this is a risk level 10.
Exactly.
Because if you think about development is always considered higher risk.
Mm-hmm.
But then you've got people who are, that's their life is to be developers, and they put food on their kids' table because they're developers. They view risk much differently. The other thing is, it's what I find is really funny is experts are often wrong. We pay people to be experts and they're often wrong, and their job is to be the expert. And it just kind of brings you back to earth and realize that you got 1,000 economists out there. They all say something different, but for some reason, psychologically, we have to have that input from these economists, despite most of the time they're wrong. So sometimes it helps to have that broader knowledge. Sometimes the experts are not the ones that should be guiding your investments. This economist says rents are going to start increasing this year. They could very well be wrong.
Yeah.
So that's what it takes. You almost have to dive that next level deeper rather than listen to the broader experts on TV.
I think that's an important part. And I think we'll kind of close around this topic, which is the quote unquote talking head. The expert is, I think we give a lot of credence. There's a lot of value in looking at data, right? Looking backwards at data and trying to forecast things. But there's also a lot of credibility that comes with, yeah, but have you ever done it? Have you ever looked at this deeper, like the hands-on learning? And that is also that experience that you're talking about here. And this closed story here, I think, is about that question that you had got. Is like, Flint, but have you ever built an airplane? And so to actually spend the time to go and look at these different asset classes, go a mile deep in a lot of places, and go and find this plane kit, right? That you had instructions and manuals and these kind of things to put it together with your hands. When we talk about that story just quickly, how did that go to put this together?
Yeah. That's the tiny model of basically we built a full-size aerobatic airplane, a little 2-seater. But yeah, a team of engineers, we got together and said, we're going to build a kit airplane. And it's funny because people say, have you ever built an airplane before? It's like, so actually taking this even further, in the FAA world, even on commercial aircraft, we all had a joke that you cannot put new technology onto an airplane unless it's flown before. And we took that, it almost became so literal that Boeing went out and created they called it the Eco Demonstrator, which was an experimental airplane where we could put new technology on it and fly it as an experimental airplane.
Oh, cool.
To check the box that this new technology has flight hours on it.
That's funny.
So the same thing goes. Like, have you ever built an airplane before? We're like, no, but we're engineers. We know how to read instructions, and we're actually very capable with our hands. We'll just do it.
Yeah.
This is what all kit airplanes are. Nobody has had experience building a kit airplane unless you build a kit airplane. So yeah, we did it. And what's crazy is the instructions start out very detailed in the beginning. And then as you get further and further along, they become lesser and lesser detailed. But at that point, you're more knowledgeable and capable. And then at a certain point, the engine install instruction is literally install the engine. And there's way more complexity to installing an engine. There's so much stuff going on. But at that point, you figure it out as you go.
Yeah. And that type of story, which I think is so appropriate here. You do want, like, organizations that win are there because they have people that go and solve hard problems. Not everything is going to have an instruction set. And if they do, there's going to be various levels of detail. And at some point, it's like, we're going to do this. We got to figure it out. And those are the people that you want on your team that are just going to keep moving along and moving forward to solve problems. So, Flint, dude, appreciate you being here, and I had fun. There's way more questions I want to talk to you about, but we're right at time. I know you're active on LinkedIn. Talk to people, talk to us where they can find you, any other resources you want to send them to, including your book.
Yeah. All of that stuff can be found actually just on my website. It's vestuscapital.com. And if you don't know how to spell it, that's fine. I should probably rebrand. If you go to investwithflint.com, it'll take you right to my website.
Nice. I'll make sure those in the show notes as well. Check out stuff there. And yeah, I look forward to reading your book too. Thanks, Flint.
Yeah, appreciate it. Thanks.
Cheers.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.